everyone. Thank you so much for joining so quickly. We're so excited to have you. Hopefully everybody's got their speakers all set up and are comfortable. Make sure you get a notepad. It's going to be interesting. And let me get you over to Jeremy Wilson, our Vice President. He can get us started with some welcome.
Hey, good evening. Thank you so much for carving out a little bit of your time on this beautiful evening. Jeremy Wilson here, Vice President of Northern California for Keystone and representing Manor as well. So thank you so much for really, your time is extremely valuable to us. We understand that. We understand that you have quite a bit of a responsibility when it comes to serving on your board, taking care of your communities, and you allowing us to spend a little bit of time with you this evening means the world to us. So thank you very much for allowing us to come into your house, wherever you are this evening, and share some great information with you. I am super excited about this topic. I will be taking notes as we go through this as well, because there's a lot of great information from some extremely knowledgeable speakers this evening. So with that, thank you once again for being here. I will hand it back over to Kristen.
And thank you so much. This was a really fun curriculum to put together with our amazing instructors, we'll call them. They're our speakers. And I just want to put a disclosure out there right now. If you are in a condo, or if you own a condo, or if you want to own a condo, this one is for you. If you don't and you have no interest in condos at all, I think you might be able to free up 2 hours of your time, just as a heads up, but we're happy to have you if you're willing to stay along with us, because you know how things work. So I am happy to present our speakers, starting with Charlotte Allen. She is a self-admitted fashion failure and wannabe home chef. She has successfully aided in the acquiring and retention of ensuring over 2,500 common interest developments. As Director of Education and Industry Partnerships, Charlotte works collaboratively with fellow agents to highlight Socher Insurance Agency's service, knowledge, and dedication. Her commitment remains focused on educating common interest developments and their managers. Socher Insurance awarded her the Jack Socher Founders Award in 2015 for her dedication as a team member. And then in 2017, she earned her designation as a community insurance and risk management specialist. Charlotte is also a devoted wife and mother of two and spends countless hours volunteering in and around her community. Thank you so much, Charlotte. And we also have Kieran Purcell, and he's a CCAL, and he's an attorney who works on behalf of community associations and provides advice on all types of corporate matters. He has been a shareholder of Epsten APC since 2002 and now serves as managing shareholder, president, and CEO of the firm. Kieran served 3 terms on the board of directors of the San Diego chapter of the Community Associations Institute, where he served as president and co-chaired the National Seminar Committee. A former chair, Kieran now serves as an emeritus delegate of CAI's California Legislative Action Committee, CLAC, and as a member of the San Diego chapter of CAI's Legislative Support Committee. Kieran is a 4-time recipient of the San Diego Chapter's President's Award and the Samuel L. Dolnick Lifetime Achievement Award. In 2023, he was recognized with the San Diego Chapter's Legacy Award. Whew! And then we have Natalie Stewart. She is the president of FHA Review, a California-based third-party submission service that specializes in the FHA and VA condominium certification process nationwide. Established in 2011, FHA Review has been focused on assisting condominium projects nationwide with FHA and VA certifications, and her team has successfully completed thousands of condo approvals each year. She has spent the last 20 years in the CID industry, an active member of CAI. She has actively participated in many CAI chapters as committee member and chair of several committees. Currently, she's serving on the CAI Federal Legislative Action Committee and also the Greater Los Angeles Chapter Legislative Support Committee. So all that to say, we have some heavy hitter speakers tonight, and they're going to get into it. So I'm going to go ahead and toss it back over to you, Natalie. Thank you guys so much.
Sure. Thanks, Kristen. So next up, I'm going to update my bio and make it as good as Charlotte's and maybe try to win some more awards so I can compete with Kieran in the future.
I'm looking at the background of where Charlotte is. She's got a lot more awards just sitting there behind her. So I think we both got to step up our game.
Yeah. Nonetheless, I am here today to talk about all things condominium financing. And this is a topic that in the past, it's somewhat flown under the radar. There's a lot of educational programs that you might go to that are about strictly about insurance or strictly about reserves or new laws that might be affecting your communities. But condo financing, meaning the ability for your owners to finance and get mortgages, has been a topic that has been kind of, not at the forefront of our managers and boards. And this is because it really wasn't important until very recently, because it was really handled on the lending side. And the actual criteria was a lot looser than it is now. But the first set of changes that we might have felt, or that anybody here might have felt, would have been after the 2008 subprime mortgage crisis. At that time, lenders did tighten up and FHA changed their criteria. Fannie Mae added some additional lending requirements, and it was kind of felt then. But everything, the market collapsed, and we didn't really focus on those issues at that time necessarily. We all kind of adapted to them. Then in 2021, we had the collapse of the Champlain Towers condominium building in Surfside, and that's when some major changes at what is the biggest player in financing, Fannie Mae, happened. And so since both of those situations, the housing crisis and the Surfside collapse, lenders and the government supported finance programs, Fannie Mae, Freddie Mac, FHA, and VA, they've all restructured programs, and lenders are now requiring more information from associations prior to funding loans. And that directly impacts your communities, and honestly, probably most of the people on this call. If you're a condo owner, there's a good chance you might have a mortgage on that house. And there's also a good chance that sometime you want to sell it. And so all of this affects you as a homeowner, a board member, and then any managers on the call. So today we are going to try to discuss understanding first the financing options that are available to your buyers, your potential owners, and your current owners. Recognize the most common reasons loan gets denied and how to prevent them. Learn what documents, decisions, and policies might have the biggest impact. And then importantly, what to do when a lender calls with an issue, or how to get that information and how to make sure that things run smoothly. So first, let's discuss condominiums. Let's go to the next page. Oh no, actually we can stay here for now. Condos. Why does this matter in condos and not other forms of housing? Condos have additional underwriting requirements because lenders are evaluating both the borrower and the association themselves. So when a person buys a condo, you're not just buying a unit, but you're also buying into the shared ownership, legal and financial structure that's managed by your association. So that in itself adds a layer of risk for the lender that doesn't exist with a detached home or even a PUD where the ownership structure is different. So the condominium association itself has to be underwritten separately, as well as the borrower. And the interesting thing is the way that the condo association is underwritten depends on the qualification of the borrower. So you'll find that sometimes a very high qualified borrower, and when I say high qualified, I mean somebody that has an excellent credit score, a high down payment, a long tenured career, high income, just a great borrower from a banking perspective. The lender is going to allow a little more risk to happen on the other end. When the borrower is not as qualified, you might have a higher debt to income ratio, you might have a lower credit score, a lower down payment. That's when they really study the association and the finances and what's going on there. So as much as I'd like to say that all of this information is, in the box that the government puts it in, the lenders do have a little bit of leeway in approving certain loans in communities that might not be as highly qualified as others. So it's all very nuanced, which is why it actually causes so much concern, because you can't just put it in a box and check things off. So let's start with, the simple truth is that if you can't get a loan in your community, nobody can sell, you can't refinance, the values are going to drop. It's most likely that your condo or your home is the biggest asset that you have now and that you might have at any time in the future. So you want to be able to protect that asset. The government agencies that do most of the loans in the United States, you have Fannie Mae, Freddie Mac, FHA, and VA. Those provide the majority of mortgage-backed financing in the ways of Fannie Mae and Freddie Mac that warranty that it's a good condo. You've got FHA that provides mortgage insurance, and VA guarantees that loan for the veteran that has that loan authority. You'll find that Fannie and Freddie, based on most market research that I can find, they account for about 70% of all loans. And so that's why you really want to focus on those two. Fannie Mae most specifically, because Freddie Mac you'll find is generally smaller banks and credit unions, and Fannie is your Rocket Mortgage, your Wells Fargo, the bigger banks that it's traditionally that an average borrower will go to use. FHA is a great tool for first-time borrowers, seniors, the reverse mortgage project known as the HECM loan, the home equity conversion mortgage. That's an FHA loan product. And then borrowers who might have a lower credit score or higher debt to income ratio tend to be FHA borrowers. Each of these agencies has their own set of criteria. You'll find that they're all similar, but slightly different. So sometimes you want to kind of err on the side of the most strict, which would be, I can't even say it because they're strict in different ways. FHA is like a gold standard. If you meet FHA, you tend to meet Fannie Mae, unless you have some critical repairs that are needed, and then you won't meet Fannie Mae at all. You can't say that VA takes it because VA doesn't allow any leasing restrictions. So it's very, very confusing. But you want to make sure that you are aware of at least what these criteria is and how to make sure your association is following it. If you don't meet the criteria for these standard agencies, you're going to be affected because you really just have the option of what is known as a portfolio loan. And this is a non-qualified mortgage generally, where the bank has to hold the mortgage on its portfolio. It means they cannot resell it to Fannie Mae, which means that they can't lend that money again. So a lot of banks don't do that. You're going to pay a higher interest rate, and it's not as good of a loan, and they require more down payment, and it's going to really limit your buyers. Or you're stuck looking for a cash borrower or a cash buyer, not borrower, which means that you're severely limiting your buying pool, and it's just fewer buyers can qualify for the mortgage. Properties may sit unsold, and the limited financing, it's going to depress prices and make your unit less competitive. So let's move this forward, Kristen. So recently, you might have heard something which is called the Fannie Mae blacklist. Has anybody on this call, Jeremy, I'm going to pick on you. Have you heard any of your associations at Keystone?
Oh yeah, lots of them. Yep.
Yeah.
Yep.
So I've known of the blacklist for years. And the interesting part about the Fannie Mae blacklist is the reason it's such an issue is because it's private. Okay. FHA technically also has a blacklist, but it's public. VA as well. You can look it up online. You can see what the issues are, and you can figure out how to remedy them without going through these secret channels. Since Fannie Mae has a secret blacklist, that's what we call it. It's actually their ineligible project list. And this is why underwriters are denying your projects. And when that happens, they call the manager like Jeremy and say, oh, these units, I can't sell this unit, it's on the blacklist, you need to get it fixed. And Jeremy goes, whoa, I don't even know what to do. What blacklist? Where do I look? They Google it, they call me. It's hidden. You have to call a lender. You have to give away your firstborn child just to find out what to do to get these units off of it. So in a couple of slides, we're going to go over the common reasons for ineligibility. But now I'd like to move forward one slide so that you can see what will happen to find your community on the blacklist. So Fannie Mae has created a very, very glitchy website that if you are lucky enough to get into it, you might find information such as this. There's 3 options. And just to let anybody know who wants to use this site, the information you do need is you need the name of the association, a physical address within the community, the unit count, and the tax ID. So the tax ID is that piece of information that as a board member, you might not have at your fingertips. So you might need to get your manager involved to get that last piece of information to be able to access this. You also, to get the information, have to certify that you are either a board member or a community manager. They don't want people like me or even your attorney like Kieran possibly poking around in there. I don't know why, because it would be very helpful if I could help you out. But you have to certify that you are a part of the association or the active community manager. Once you get in there, this is potentially what you will find. This is what they call the text you see on the right side of your screen is the actual text from Fannie Mae's website. This is what they call a no findings result. This means your project is in Fannie Mae's database, but there is no ineligibility notes. You should be okay. And I say should be because this just means that they haven't had any adverse information yet. If a lender then goes and requests information from your community, there's a good chance that something might pop up and they might immediately put you on the ineligible list, which, Kristen, is the next slide. If you do have yourself on an ineligible list, you will get this page, and it will say, basically in the middle of the screen, you can see that this community has critical repairs or deferred maintenance. The fun part about this is that they don't tell you what the critical repairs or deferred maintenance that they've identified is. They don't tell you who gave them that information or how it got to them. So then you have to do the detective work and back up, and as Jeremy might have to say, go call his escrow department and say, have any recent transactions happened? Did you send this questionnaire, and did you indicate this, so that you can back up and figure out which information is needed to submit to Fannie Mae. If you click on it is going to give you, if this does come up for you, it gives you a link to an email address that is never replied to. So if you send them the information, Godspeed, it might never get there, or it goes somewhere, but I don't know what they do with it. And I have never heard of one person that got a satisfactory result. I hope that this changes. It's easier if you contact the lender or whoever who called you to tell you about this ineligible issue and tell them you have information to help them, because they have direct access into the Fannie Mae Condo Project Manager database where they can clear up this issue. I wish I could directly help you, but I cannot yet. I've emailed Pulte himself, the director of Fannie Mae, to say, hey, I can solve half of your problems if you would just allow third parties to come in and assist condo projects that have the knowledge. I get communities through government agencies every day, and I could help out too. So we'll see if anybody ever gets back to me. I think I'm going to send him a letter. I have his home address. I'm not going to tell you how I got it. But also the next one, Kristen, one more slide, is that your condo project isn't in Fannie Mae's database at all. That's okay. That just means a lender has not put it in at any time. It does not mean anything negative. It just says we haven't reviewed it and we don't know what's going to happen. It could be that you had poor information. I'm sure as condo board members, you know that there are tons of communities with very similar names. You might live in Valley Vista Townhomes Condominiums 4, and they have it listed, and you use a Roman numeral, and they use the how do you say, not Roman, the actual spelling of the word for?
Arabic for.
Yeah. So there's many opportunities for you to have an inaccurate search and not feel like it was inaccurate at all. That could happen very, very easily. But don't freak out if this is your response. This is way better than ineligible. This just means that the project that you are looking for doesn't exist. I'm also going to say this website, Kristen, I can send you the link if you don't have it already directly to provide to people who want to use it. It is, it spins a lot. It's a rainbow window of death. And also, if you use Chrome, you have better luck than Safari. So try as many ways as you can imagine to try to get into it, and then try your best. But I wouldn't commit that this is very useful. Freddie Mac has its own website, very similar. They give you a general email address that you can send documents to and cross your fingers. FHA is wonderful. I never thought I would say that. They are amazing. They answer a phone, they answer emails, they are very helpful. VA is the same. You can get somebody on the phone, you can talk through it. There are ways to get around ineligible statuses on both FHA and VA a lot easier than Fannie Mae and Freddie Mac. Moving forward, let's talk about the biggest concern that all of these agencies have, and I'm betting it's a big concern for everybody on this call as well. And this is what Charlotte, our resident insurance expert, is here for, because we're going to talk insurance right now. So Charlotte, can you talk a little bit about what lenders want to see their condominiums have?
Yeah, and I have to say, Natalie, I've learned so much because my focus is solely on the insurance. And of course, I always know when the insurance requirements aren't met that some of our condos end up on the blacklist, but that was super informative and I have a much better understanding of all the other reasons. So thank you. I gotta say, as an insurance professional, it's quite frustrating because one, this seems to be kind of ever changing. So requirements that didn't exist 3 years ago now exist today, and they're stronger than ever. And I don't always agree with the requirements that are popping up as far as, hey, you know, I know that Fannie Mae wants this, but do they really have an understanding of how the insurance works and how another option would benefit the client, the borrower better, or the association better? So it is a little bit frustrating. One of the biggest things that they want to see is 100% replacement cost. They want to see that the association has insurance for 100% of the replacement cost, which is a very hard thing to offer because we have to back it up and say, yes, that their total insurable value meets that qualification through fill in the blank. So we utilize an industry-wide calculator. A lot of insurance professionals use the same one, known as Marshall Swift. It's sponsored through CoreLogic. Feel free to look those two, up and have a gander. But basically, this is a report that gives us a good starting point for a total insurable value or a decent price per square foot to rebuild at that given time that we run the report.
And Charlotte, so we're talking, so 100% replacement cost, because I talk to a lot of insurance professionals that say that's not even a thing. It's not, I can't put it on a COI because it doesn't actually exist. It's not a real insurance term.
And that is a frustrating part because a lot of the terms that these lenders are requiring are not technically insurance terms that are utilized in policies. So we know what they mean by 100% replacement cost, but there isn't really an endorsement that states that. So that's why we have to come up with the backup, the proof that yes, in fact, on paper, this looks to be 100% replacement cost.
Yeah, because in layman's terms, they're saying if you've got 100 units and they all burn down, we're going to be made whole. All 100 units are going to get rebuilt to how they were before they burned down.
Exactly. So what we do is we state in, more words than not that you have this total insurable value. And if the lenders need to see proof that that's appropriate, then they can request that Marshall Swift report. They can match up the numbers and say, okay, yes, this looks good to go.
All right, quick question for Charlotte, Kieran, and Jeremy. Why don't people ever just send that Marshall Swift report initially?
Well, that's a great question because a Marshall Swift report, our agency runs them once a year. So when we take on a piece of new business, a new client, we're going to run that during that first initial, binding period. And then every year upon renewal, we'll go ahead and run a new one. There is inflation that can pop up, things can change. And so you're not always going to have the most accurate report at your fingertips. So we actually have a dedicated person on staff, and this is all they do. They take lender calls, answer lender questions, advise what each type of policy means, and give them an updated report if they need it to back it up.
Really? Oh, I didn't know.
Full-time person.
No, but that's interesting. I didn't know that it was that kind of dated and that they'll report it. And John, I see your hand up, but I believe they're taking questions at the very end. So take a note and then we'll get to you.
We can also put it in the Q&A feature just so we can capture it and make sure we get to it.
Yeah. And Kieran, what's required by what is it, 5150 in the state, if a lender requests the Marshall Swift report, does the association have to provide it?
So that is not on the list of items that the civil code provides that a prospective owner is entitled to ask the owner for. And so that, I think this is a Jeremy and a Kristen question, but I suspect if the owner got asked to provide that and they went to the management company, and they would probably be frustrated they couldn't get it, but the management company probably didn't have it either. And so that's, I think what you mentioned before, it's education is really the challenge in the industry, because you have a lot of folks all with good intentions, all trying to get the loan funded, and they're being fed questions, but they don't really understand what they're being asked to provide. And that's what's so frustrating about it. And you highlighted some of those good examples here today. So that's one of the things we're hopeful to do here, is help educate people so that if people understand what they need and what they're can ask for the right things, they've got a much better chance of actually getting it.
Yeah, you're absolutely right. And we do not have a copy of that report in most cases. And if you asked any one of our managers what the report was or how to get it, they would probably scratch their head. It's something that's outside of the wheelhouse of the typical community manager, because, and we don't delve into the insurance side of pulling those kind of reports. That's what we leave that to our experts, right?
Mm-hmm. And here's the thing, not every insurance professional is created equal. So this is the kind of the issue that we run into when, I know, best of intentions, you know, I'm a board member and I've got a friend of an ex-wife that does insurance, you know, let's call them up. But here's the thing, you know, there's a lot of red flags that can pop up when it comes to an insurance professional. Doesn't make them bad at what they do. I love a good State Farm agent, but a good State Farm agent writes everything from automobile coverage to workers' compensation and life insurance. When you're working with an expert in the HOA industry, they're going to have an idea of, one, what the Marshall Swift report is, or CoreLogic report is, and they're going to have it at their fingertips. They're going to know the requirements from, you know, the lenders and what insurance policy checklists they need to check off in order to offer an insurance policy that's going to meet those requirements. They're going to know what governing documents or CC&Rs are. So if you're talking to an insurance agent that's not sure of any of these terms and doesn't know how to provide this information, rest assured it's going to become an issue if you are trying to sell your unit or there's a unit for sale within your condominium complex. It does pay well to trust an expert, you know, an HOA insurance specialist that can have this at their fingertips. Like I said, I mean, we're not the only agency that does this. I have plenty of friendly competitors that do the same, but we have a dedicated full-time person solely there to provide answers to lenders and get this information over to them.
Yeah, and if so moving on this slide, if they doesn't have the words 100% replacement cost, but it offers extended or guaranteed, can you kind of discuss those?
Yeah, so this is also interesting because I have found guaranteed replacement cost is an endorsement available to some insurance policies. Many insurance carriers will offer this endorsement. And basically how it reads, or in summary, is that we're going to give you this total insurable amount based on that Marshall Swift report or, you know, an evaluation that you have. And we're so sure as an insurance carrier that that is an appropriate amount. We're going to tack on this endorsement guaranteed replacement cost that states if it's not enough at the time of a major loss, we will guarantee full replacement, whatever that might cost. For whatever reason, we have found on our side of things that lenders actually prefer extended replacement cost even over guaranteed replacement cost. I scratch my head at this all the time, but that's what we tend to see. Extended replacement cost is also an endorsement that insurance companies can offer. And basically it states you have, again, enough in your total insurable value. We're so sure of this, we will add an extension, usually about 20%, 25%. I've seen it as high as 50%. And we're saying that if there's a major loss and you exceed that total insurable value due to inflation, we will cover up to 25% more, 50% more. Now, here's the interesting fact. Even though lenders really like this endorsement, insureds need to understand how the endorsement reads. The endorsement states that you still have to have a correct, adequate total insurable value to start with in order to be eligible for the extended replacement cost. That means that at the time of loss, if the insurance company comes out and says, you should have been insured at $10 million, but you were insured at only $5 million and added this extension, you are not eligible for the extended replacement cost because you're not meeting the qualifications of the endorsement. Now, do the lenders have an understanding of that? I think not, because they tend to just see this endorsement and like it and move on. But I always want to paint that more accurate picture for the insureds so that they understand how the endorsement will actually play out in case there's a loss.
Yeah. I'm 100% guaranteed that they don't understand the extended replacement cost. But moving forward, let's talk about the number one reason that Fannie Mae is rejecting condos regarding insurance. And that is, well, actually, no, that's 100% replacement cost. The second is the deductible limit.
Yeah. So what we're finding, and I'm sure a lot of folks on this call, unfortunately, have been in this position. Many of our insureds were once insured by the standard California admitted insurance market, you know, those household names that you hear of: Farmers Insurance, State Farm Insurance, Travelers Insurance. And just as loans have become, or lending institutions have become more strict, insurance carriers after Champlain Towers and a number of other losses have become more strict on the types of properties that they're willing to insure. And so a lot of you and a lot of our clients have had to turn to what we call the surplus lines market, the excess market. One of the most popular surplus lines companies that we all hear about in the tabloids, Lloyd's of London. We've had to turn to alternative carriers like that. With that came some unique deductible options. And so one thing that we're starting to see, or that we started to see a couple years ago from these surplus lines carriers, were per unit deductibles for our condominium projects. And the lenders have stated that if your deductible, your association's deductible, exceeds more than 5% of the total insurable value of your project, this is a no-go. And what they're doing is they're looking at these per unit deductibles, multiplying it by the number of units there in your project and saying, uh-oh, this total number exceeds 5% of the total insurable value.
So Charlotte, this is also based on just people not understanding the process, because that sort of just assumes that, hey, the only way that association could ever possibly pay the deductible is by drawing money from their reserve account, which of course, you know, Brian and Jeremy and Kristen will tell us is not true. But nonetheless, that's perception is stronger than reality sometimes.
And that's 100% how FHA looks at it. FHA doesn't have the deductible limit like Fannie Mae. FHA looks at your reserve balance. So if you have a deductible of $25,000, but your reserve balance is 20, not getting FHA certification. So it's, or if you have that per unit deductible of $25,000 per unit, because that did sound like a good idea. I completely understand why.
It's math. What could go wrong?
Right. And the whole place isn't going to burn down. So we won't have this catastrophic loss. And then you add that up, that's way over most reserve balances.
Right.
And FHA says, no, you're gonna have to go back to the drawing board.
Right. And again, going back to, if you're working with an insurance professional that doesn't understand, they just get this quote for, oh, per unit deductible sounds good to me, this is their best bet, and sticks it to you, but does not understand that suddenly when someone's in the 11th hour of closing, on a new condo, oh shoot, we don't meet the qualifications because our deductible exceeds that 5%. So very frustrating if you haven't received that education and you're not working with an insurance professional that understands. I also want to say that if you find yourselves insured with a policy that offers the per unit deductible and you know that it exceeds, there is an endorsement that the association can purchase, again, through some insurance carriers, where it states your deductible will never exceed 5% of the total insurable value. But I will say it can be costly. And of course, Natalie, I know when we were discussing this presentation, you asked me, well, what's costly? And so I do want to give you guys some numbers here, but it fluctuates so much. A smaller association, may only have to pay only $1,000 for this endorsement, but we had a larger project just last week. We asked for the endorsement, or the cost for the endorsement, and it was $30,000 just to get this endorsement. So needless to say, we are continuing to shop for other policies that may not offer that per unit deductible, and see what we can do for the client.
Yeah, that's great information, honestly. There's a lot of people in that situation that I don't think know of that endorsement. But also so moving forward, a new situation that has just started coming up in my world of condominiums getting rejected is the inflation guard. And it's tricky because it's required, but only if you can get it.
Correct. So yeah. They are requiring that if your project is insured by an insurance company that can offer inflation guard, that you have to have it. Which, good news, again, if you're working with a seasoned professional, they're automatically going to give you a policy that has inflation guard on it. However, there are several insurance carriers out there that cannot offer inflation guard. And when we were first asked to do this, and again, it was more recently than not, we had to fight back and let the lender know this particular insurance company, they have no capability whatsoever to offer this inflation guard. So now what? And it had to go up the totem pole. We had to talk to 14 different people before they had any sense of this. And Natalie, I'm sure you see this too, but all of that information has to trickle down to other lending institutions and other people within the organization before people finally get it.
Well, and this happens all within like the final 10 days of a sale.
Of course.
So, that's like in theory, oh, the board's trying, the manager wants to help. We talk to the insurance agent says, wait, what, inflation guard? We don't do inflation guard. We operate differently. And in another way that used to always work for the past 50 years that I've done insurance. What are you talking about? So then we have to go through this whole education process on that and go up the chain. And by that time, your loan is gone. Like long gone, because then you have to go to a board meeting, and these are possibly monthly, possibly quarterly, to discuss this situation. And it's educating the board and the manager, and the homeowner's angry. The person who's trying to sell, the borrower, it's very difficult, which is one of the big reasons we're talking about it today, is so that everybody can just kind of start educating themselves on what these issues are.
Yeah. And I mean, best case scenario, you want to be proactive on this and already have a policy in place that has the inflation guard. The nightmare that you run into is, even if you're working with an insurance professional that can easily get that inflation guard, add it overnight, no problem, it's still going to take some time to get that bound. Or if it's going to be a costly endorsement, the board will then have to decide, do we want to pay for this endorsement because we have, a loan that needs to fund?
It's also one of those things that I never even looked for until it was important. It's on a COI. It's on a lot of them. I'm going to tell you that right now. It's on plenty. It's also not on a lot, because it wasn't information that when the insurance provider was providing those COIs that go to the management company that make it so easy for us to tell what insurance they have. It's not on there because it didn't really matter to the lender until it mattered to Fannie Mae. And so now that it matters, we're seeing it more and more often, but you might have it and you just don't know it because it's not one of those things that you look for when you're looking for the deductible or the amount of insurance. Oh, and by the way, do we have inflation guard?
Right. Well,
never something you've asked before.
Here's another thing. So COI, certificate of insurance, just in case anyone was wondering, I know acronyms are a fun thing. But here's the other thing. COIs are really only summaries of your insurance coverage. Obviously, your insurance coverage is going to come from the actual policy language. So as insurance professionals, we have to decide what is the most important thing to summarize on a COI. And yes, there's best practice, but then there's this whole caveat on what is the best thing to disclose so that our clients can get loans funded. And so if you're working with someone where 100% of our business are common interest developments, we're going to pivot a lot faster and start putting those necessary items on the COI versus someone who 99% of their book is non-HOA and suddenly they're asked, from a lender, I need this, this, and this listed. It gets very confusing. I understand that. And I'm not surprised that we see COIs that don't list any of this. And, let's not panic. It doesn't mean it doesn't exist on the policy. It's just plain and simply that insurance professional didn't know that this was one of the more important facts to put on that summary.
Yeah.
I think that one of the industry shifts that I'm seeing, it used to be that the COIs were really poorly prepared. And I think the insurance providers have started, so it wasn't like the most recent person you hired is like, oh, we'll stick him on the, certificate of insurance desk. And they get to crank these out all day. So I think that the providers have figured it out that this is really important. And so you have your better training and better folks who are doing this, because the certificates of insurance seem to have gotten better in the last few years.
Absolutely. And I think they're just tired of hearing from me and my staff who's calling them.
They have mentioned your name specifically a couple times, Natalie.
Yeah. And then also this past, 5 years, specifically since, we talked about, the 2008 subprime mortgage crisis. We talked about Champlain Towers. We are in an insurance crisis in California. So recently and I don't know how many people are talking about it anymore. Jeremy, you could chime in if you have communities that have thought about this, where condo projects have decided to shift from carrying the master policy, like their original declarations were written, to having each individual owner carry individual insurance. And Kieran, do you want to jump in and talk about that idea?
Sure. I've seen it a couple ways. Like the other variation you see is where, and it's often the board member whose brother-in-law's, wife's sister twice removed on her cousin's side is in the insurance business and says, hey, we can save a ton of money on our insurance if we just go to a bare walls, bare floors policy. And then other people on the board, of course, that money is tight and they're trying to not have their assessments go up, and they've got a lot of needs and a small amount of resources, and they want to jump on the bandwagon of that, and they don't oftentimes realize, and unless they have a sharp management team, like you've got all your folks at Keystone and Manor, who are smart and know how to look for this. So you got to look at your CC&Rs and see what the CC&Rs even provide to see if you can even do that. Otherwise, at some point, some lender might look at it and say, hey, wait a minute, or FHA, Fannie, Freddie, they're like, wait a minute, they have insurance requirements too. And so those CC&Rs, when they're originally written, are reviewed by the lenders to make sure that they meet that baseline criteria, because they want to make sure that if they are writing loans in that community, that they are protected, that their collateral is going to be there. And so that's the first thing people make a mistake on, is not looking at the CC&Rs to see what they require in the first place, and then they're trying to shift away from that. But the trend you're talking about, and one of our colleagues in the insurance industry referred to it as the nuclear option, which lets you know it's not a great choice, but it's kind of like the FAIR plan, right? It's the plan of last resort. But that they talk about amending the governing documents so that the association is responsible for less in the maintenance, repair, and replacement side, and that gets shifted over to the owner. And so the thought process being is that it's the loss history for individual owners doesn't tend to have the stigma that it does for an association. And so the cost of insurance for an individual owner generally is lower than the pro rata cost if it's spread out for the whole community. So there's logic behind it. But the challenge of actually getting your documents amended, which generally, if anyone here hasn't done it, typically, if you're talking about association documents that haven't been adjusted or amended at some point, your CC&Rs generally require 75% or a 67, or excuse me, 66 and 2/3. So, some sort of super majority homeowner approval in order to amend the documents. And so the effort to go through is really not necessarily going to pay off at the end. And so this is not something we generally recommend. I've seen a number of associations come to us and say, we would like to do that. I've only seen one that's actually gone through the process and achieved it. And it was a smaller association because they just getting that required approval authority is challenging for most associations. And so, Jeremy, I'd ask you if you've had, or Kristen, if you've had some of your folks do that, and if at the end of the day they actually succeeded, and if they ultimately ended up being happy they did it.
Yeah, it's a good question. So I heard talks of this from boards probably mid last year. It's since calmed down. I don't hear much anymore. I think that trend is somewhat fading itself in the industry itself, at least through the channels that I deal with. So I don't see it too much anymore. I don't know that I've seen it been successful. I've seen it attempted, but I don't know that I've seen it successful. It's simply, passing the burden from one entity to a homeowner. You're going to pay one way or the other, right? I mean, that's just how it kind of boils
Right.
down. You're paying through your assessment or you're paying through your checkbook to do the same thing you're trying to do. And the goal, obviously, as you said, Kieran, was to try to get a better rate when you're going through the homeowners, experience modifications and that kind of stuff. But yeah, I've just not seen it be prevalent. I've seen the discussions happen, but not prevalent at all.
And I
Yeah,
think
and
part
I'm
of the
gonna
challenge is on the homeowner side that sadly there's a segment of the homeowner population that thinks of the association as kind of the landlord, right? And they're like, well, wait a minute, the landlord used to cover the insurance, now they're making me cover it. And it's like, well, the landlord's not some third party entity that lives out there somewhere. They're actually 100% of the members collectively doing it. So I think that's a challenge, is trying to educate the members that we want the same pie of insurance, and we're just looking at creative ways to provide it. And really the board is trying to find what's the most cost-effective way to buy that pie. But that's a tough sell to the members, particularly when they look at it as, what's the size of the check they've got to write every month for their insurance premiums. And they sometimes get bogged down in that. So it sounds good on paper, but it just, I don't think in reality is a realistic solution.
Yeah, as a soccer mom, I tend to yell out, "Good idea, good idea." And so I'll use that term for this. It is a good idea. It was a good idea, and I think, Jeremy, I'm with you. This was talked about probably, a year ago, up to maybe 6 months ago, and I think a lot of that had to do with the initial sticker shock that associations suddenly were going from the standard market into the surplus lines market and seeing these crazy 200%, 300%, even 500%. Increases in premium, and they were scratching their heads and going, well, how can we navigate this? I did have several clients come to me and say, hey, what about this? And my first, response, of course, is, well, let's get your attorney involved and let's figure out if it's really worth it. And I think in the long run, it ended up, for most of our clients that were having that conversation, in the long run, it wasn't worth it. Or even if we had one that was really adamant, it felt like it was a good idea. They had the attorney on board. We were running town hall meetings, getting everyone involved, and they didn't get the vote to make the amendment. So it's not as popular anymore, because here's the silver lining. Those insureds that turned to the surplus lines market 2 cycles ago, 2 years ago, 1 year ago, we're starting to see those insurance premiums actually decrease and or steady versus increase. And now a lot of our insureds have had some time to digest what put them into the surplus lines market to begin with, and start to amend some of those things. So if it was, your electrical panels that you needed to be replaced, or a major roofing project that needed to take place, they've now had a good cycle or two of insurance renewals to address those issues and then work their way back into the standard market.
And Sean, one of the cool things, I mean, there's certainly challenges to going to the surplus lines carriers, but one of the things that I think is often overlooked too is that we have a fairly challenging bureaucracy here in our California Department of Insurance. So the ability to be nimble and kind of move with market forces and make adjustments to the policies and the premiums just isn't available at the moment. Oh, it's getting better, but it's not better. It's not getting better quickly enough. But so you see the surplus lines carriers have the ability to kind of change things a little bit, and they're coming up with some creative solutions, which may trickle down to California eventually. And so there is some goodness in that, although initially people feel like it's a death sentence when they get that, but it may ultimately not be.
Well, and I say this all the time, for a lot of our clients, the surplus lines markets and their creativity is what saved our associations, kept them insured to meet those requirements of the governing documents, to meet the qualifications of the lenders. And, you know, the surplus lines market, I call it kind of the wild, wild west, right? They can charge what they want. They don't have to adhere to the Department of Insurance requirements, which can be frightening, but also they were able and are able to pivot write in policies and do very creative things with the policies to meet the requirements of lenders that our standard markets just can't do because of the Department of Insurance and some of those well-intentioned, you know, kind of loopholes, right?
Right.
Yeah. Okay. Moving forward on this slide, Fidelity Insurance. Fidelity Insurance, almost 20 years ago when FHA changed their guidelines, this was a huge change to the industry. They put a requirement that the association had to have 3 months of assessments plus the amount in reserves in their Fidelity. This is also your employee dishonesty or crime insurance. Then Fannie Mae, I think first, so FHA did it first, the state of California then backed it up and said, this is civil code. And Fannie Mae added it to theirs. So Charlotte, what exactly do they need to do? And this is the easiest insurance.
It is the easiest. It's the easiest and actually the cheapest.
It's my personal favorite.
Yeah. So obviously every year upon renewal, we're going to ask your community manager, you know, is this number still accurate for 3 months dues plus reserves? Obviously that can shift. If you've used some of your reserves for projects that you needed to do, that amount can shift. So every year our goal is to get that number right. But if it does fluctuate and you need to endorse the policy to increase that number, it's usually very easy and very nominal cost to do it. So I agree with you, Natalie. This is one of the easiest things. To be honest with you, we did this as best practice. It was 3 months dues plus reserves as best practice in our industry, well before it was a requirement and well before it became statute.
Yeah, that's great. And then do you have any tips for managers and boards on what to do each year to make sure, because the insurance is one thing that changes. We've lost our PowerPoint. That changes often. And what should our managers and boards be doing?
Yeah, so I always say we want to discuss the renewal early. We work 120 days before your renewal date. We're reaching out to your community managers and asking them these questions, right? What has been done to mitigate loss? You know, looking at those reserve studies, making sure that the fidelity bond is still accurate. We're also having the discussions if you had an insurance carrier or currently have an insurance carrier that's made a recommendation to the association. Hey, we went out there, we see that you've got asphalt that's starting to lift. You want to make sure that you're working on this project. We want to have that conversation well before the renewal date. Find out if in fact you've made those adjustments and worked on those recommendations, because the more you do to paint that pretty picture for an insurance carrier, the better painting we're going to make for them. And we're getting ready to market every year. So we don't just take the renewal's word for it and call it a day. We want to market and make sure that you still have the most robust policy that meets the requirements of your governing documents and is, of course, the most affordable to you. So it's really important that we know what has been done to the association to meet these requirements. One big one, this is the biggest red flag on the insurance side of things and maintenance side of things, is going to be those electrical panels. So anyone that's ever heard what I call kind of the 4-letter word in the insurance industry, Zinsco electrical panels, Federal Pacific is another one, Challenger. There's a few names lingering out there that are deemed dangerous electrical panels. If you know you have them existing within your association, you want to change those out well before the renewal date so that we can package that up and let the insurance carrier know they do not have these dangerous electrical panels at their association. The second biggest issue for insurance carriers offering you a policy, both California admitted and non-admitted carriers, is maintenance. You know, remember, an insurance company does not want to be a maintenance policy. So they want to know that you've done all of the maintenance that's required of your reserve study. When was the last time you replaced your roof? All of this documentation, all of this information is going to be really helpful upon renewal. So taking care of that maintenance early and getting that over to your insurance professional as early as possible is going to help you in the long run.
I agree, Natalie, with everything that Charlotte said, but I would say that while that 120 days prior to renewal date is a good start point, I think the key really starts earlier than that. And it starts with, one, picking a good management team, right? People who are educating themselves, staying on top of these rapidly shifting issues. And so they understand the challenges you're dealing with. There's always going to be someone, again, coming up, homeowner or board members like, hey, we can save $1 a door to do this. It's like, hey, it's not about, that's a dumb place to save money. Like having very qualified people who get you access to people who are insurance professionals who are knowledgeable about the world that you live in, or if you do run into a challenge, can get you to people who are knowledgeable at helping resolve the challenges that come up and funding those loans is really, really important. And so I would say that the best decision you make early on is having a decision to work with qualified management professionals who kind of, one, understand the world to live in, and two, can get you to the educated service providers that when you have challenges, they help you find solutions.
Yeah, that is incredibly important, especially since we all know that boards change. They could change more often than not, but when you have a board member change and you have that qualified manager that can provide that leadership, because if often when a board member leaves, they take a wealth of information with them, and the new manager or the new board needs to kind of have the education and be brought up to speed on why the nuts and bolts of the insurance are important. So that is well, that is the most important, is finding your great management team to start with. Okay, so let's kind of move forward. I feel like we've talked about, well, 2026. Is anything important coming for insurance next year, Charlotte? Is there a good outlook? Are we all going to save money?
I mean, again, the surplus lines market is a softer market that we're seeing right now. So that's good news for those of you that had to be insured by the surplus lines market. The other good news that we're seeing insurance carriers, California admitted insurance carriers, coming back to the market, wanting to get back into the California market or wanting to enter the California market for the first time. So think about insurance carriers that may be specialized in, the East Coast states and are tired of hurricanes. They want to come to California. We're all keeping a really close eye on that. We've also got the Department of Insurance that is making a whole lot of promises. And if they act on any of those, great, I'll hold my breath. But we are pressuring them to see some real changes. And I'm pretty optimistic for 2026 that we're going to start exiting this hard market in the next few years, and that we're going to start seeing some of those changes.
Good, thanks. So moving forward, before we kind of talk about this Fannie Mae condo questionnaire that initiates kind of all of this information and digging around into the association's history and their insurance, let's talk about what happens when you go to buy a condo. So first you have a buyer. Let's say I'm the buyer and I'm going to go to my lender and I'm going to get pre-approved. And they say, you look great, Natalie, go shopping. Then I go online, I talk to my realtor, and I find all of these great condos. So I look, I visit, I find the condo of my dreams. The seller accepts my offer. The property is marked pending, so it's no longer technically on the market. I go under contract. I put my old condo up for sale, my old house. I'm moving. I've got a buyer who's ready to buy that house. I give them my earnest money. And then my lender, at this point, after all of that has happened, my lender requests the condo information. If you ask me personally, it's so backwards, but this is just the cycle, the sales cycle of a condominium and all other homes. 3 to 10 days later, we go to whatever the document portal, probably that Keystone sends me to. They're ordered in 3 to 10 days. I get what is called the condo questionnaire and all of the backup. My lender then sends it to the underwriting team. Then they start with the red flags. I am at sometimes 20 days into a 30-day escrow before any red flag is identified. So then my realtor and my lender calls my realtor calls Jeremy and goes, this doesn't say 100% replacement cost. What this, you check deferred maintenance. You've got this, and this. I need this information and I need it. When do they need it, Jeremy? Because I think they need it now. And they expect Jeremy to react
yesterday.
Yeah. And because it's Jeremy's fault at this point, because Jeremy answered the phone and he's the one holding up the sale. Is that right? Did I do an accurate description of how it happens?
Sounds pretty correct.
Don't answer the phone about 3:30 tomorrow before the long weekend, Jeremy, because that's going to be somebody's escrow company calling.
Yeah. I mean, and so that's when this panic happens. And so what initiates the panic is generally the lender, the Fannie Mae questionnaire. So the next page, Kristen, the next slide. Okay. It looks like we dropped that again, but the questionnaire, what is on the questionnaire? You've got the basics, the name, address, number of units, the owner occupancy. That's important. It's not as detrimental unless your community is incredibly high tenant occupancy, and I'm talking like 65%. So 50% is a good threshold to kind of think in your mind, but you can get over 50% loans with FHA, VA, Fannie Mae, all of them. So when you get into that super high non-owner occupied units, that when it goes into trouble. And so Jeremy's team, I'm positive you have an escrow department that completes the initial questionnaire and sends everybody that information. And sometimes there are mistakes that happen. I've seen that people check off, oh, it's a condo hotel. There's timeshare units. Things like that happen. Things like that are easy to fix. It's kind of what happens when you have to answer the tricky questions like, is there any deferred maintenance? Because I'll ask you that, Jeremy, right now. Is there any deferred maintenance on your community?
Well, of course.
There's always deferred maintenance, right? What is
Jeremy
the
is going to say it
definition?
depends on how you define deferred.
That's what I was going to say, Kieran. So this is what this, and I hope that the boards can appreciate this. So the management company gets this, and like, there's always deferred maintenance on any home. There's deferred, something that somebody will classify as deferred maintenance. So then so Fannie Mae figured this out, and they said, okay, so we now need to know if there are critical repairs needed. What's a critical repair? And then so they decided to define that. And they have a very long, convoluted definition of, structural, my least favorite word, habitability, and things of that nature. And then a dollar amount associated with it. So if there's more than $10,000 per unit unfunded, then that's a problem. But in California, we have a new issue, and that is our SB 326 reports. And Kieran is here to make managers and boards feel better. I am here to tell you that they are all going to call you and ask you for all of the information on all of their reports. I'm going to call you and ask you to give me more information than you want to give. And Kieran, what should managers and boards do when people ask for that information? And also, how should they answer that question? If there's because just to inform everybody, there's an actual question that says, has a engineering or structural repair report been performed within the last 3 years? If you're a condo with exterior elevated elements in 2025, there's a darn good chance you had your first structural repair report done within the last 3 years.
Well, and the thing that's challenging about it, so SB 326 got codified into the Civil Code as 5551 of the California Civil Code. And so it talks about visual inspections. And many times those visual inspections are performed by architects. So there's an argument that, and now this is not me giving you legal advice, this is just me talking. But so talk to your HOA insurance, HOA legal counsel before you do this. But there's a school of thought out there that says, well, wait a minute, the questionnaire is asking if we've done a structural inspection. We haven't. We've done a visual inspection, so maybe we don't have to do this at all. And so it's interesting, and Natalie, you can provide some backup on this. But so it's funny that you actually can get penalized more by meeting the California Civil Code requirement of having done the inspection than if you're one of the people who didn't do it at all. Because if the answer is nope, we haven't done one in the last 3 years, that your life gets a lot simpler. So I'm not suggesting you take that choice. Talk about that with your own legal counsel before you do. But there's a school of thought that says you might be able to do that. But so one of the ironic things about this is that you as an owner have a couple of different obligations to provide certain documents to the prospective purchasers. But when you look through the list of documents in the Civil Code you're required to provide, that report isn't on it. And you as the HOA have a long list of documents that you are required to provide to an owner if they request them under Civil Code 5200, and that SB 326 report is not on it. Expert reports of any kind at all are not on it. And so actually there's a process in place right now where one of the bills that's pending in Sacramento, that's nice to talk about something besides AB 130 today. Right, Jeremy? But so but Senate Bill 410 is actually underway in Sacramento. The idea would be to amend that Civil Code 5200 list of documents and amend that list of documents that an owner is required to provide to a prospective owner to include those SB 326 reports. So it's not there yet, but we're moving in that general direction. So that would be good to have some clarity in this process about what it is exactly that needs to be provided, which right now we don't necessarily have. And so I think it's important too to remember that when you go through this, that everybody that you talk to, whether it's from the escrow to the realtor to the management company, everyone is all cheering for you. They want the loan to go through because, as Natalie said, that having loans approved, having homes sell in that community is good for everybody. And so no one is adamantly rooting against you. But the hard part about it is sometimes when you provide that report and that the question is, okay, well, it lists red, yellow, green, or A, B, and C. They have different categories depending on who did the inspection. But now all of a sudden that the mystery about what's a critical repair is like, well, it's got to be everything on that report, right? Well, not really. And so one of the challenges that you run into as a board and your management team is wrestling with is what do you actually provide to them? And so the goal from my perspective is to try to give them as little information as possible, not because we're trying to be jerks and script your sale, but the more information you give them, the more questions they want to ask you. And it's challenging things that you can't necessarily always respond to. It's like, oh, well, we have 17 balconies that got identified to need to be replaced. It's like, okay, well, show me the report from the inspector showing that they've all been replaced. It's like, well, we just had the report done like 3 weeks ago. We're trying to go through out and get bids and so forth. But you've started opening the door and that there's questions that are challenging to respond to. And so the goal would be to try to give them as little information as you have to. One thing that's worked out generally well in many of our communities is to say, well, here's a copy of the page that talks about unit 17 or unit 24, whatever the unit is going through the escrow process, and say, here's how it applies to them. And so that sometimes is helpful because it gives them something to check the box in their side, from the escrow side, to say, okay, we've received this information and we'll move on. If you're ultimately at a point where you have a savvy person on the other side and they're asking for actually a copy of the full report, and like we said, legally you could say no, but that doesn't do anybody any good because that's probably going to torpedo the process. And ultimately, if that happens a couple of times, you run the risk of having that stigma attached to your community and finding yourself in that the blacklisted group of communities, which is certainly a place you don't want to be. And so that you as an association and you as the management team want to be careful, because if you have a statutory requirement, or if the CCNR say you have to provide this document, and you do, and then something in that document makes the lender say, well, we'll loan, but we're going to increase the percentage for the interest rate. Or if you have to say, no, we're concerned about something we saw in this report and we don't want to provide it at all, you want to be careful, because they're going to come back and point fingers at you. And we'll talk about that in a minute in another slide. But so if ultimately you find yourself in a position where you have to give that report to the lending team, you as the HOA and you as the management team shouldn't give it directly to anybody other than the homeowner. And so the way I believe Manor and Keystone do it is, I think you put that information in your condo cert. And so that way the owner can, they give that information to the lending team goes and gets it. And now it's not you as the HOA who've provided it, or you as the management company that's provided it, it's the owner. And so if something in that report screws up the deal, makes the sale not go through, causes the interest rate to go up, they can't point their finger back at you. So it's an opportunity for you to help protect yourselves as an association, protect yourself as a management team, but also hopefully help the owner get their loan funded, get the property sold, and ultimately everybody wins at the end result there. So you can provide what you need to provide and hopefully not expose the association or your management team to any kind of liability.
Yeah, I think one of my biggest concerns with this is that, the report, when it's presented to the association, is accurate that day. In 2 years after that, that report is still the last report that has been done in the past 3 years, but it's no longer accurate because 2 years worth of work has been completed. And so what needs to happen, in my opinion, what I would love to see as somebody who's part of the underwriting of these, is to see a log behind it, or an updated report. I don't know if contractors are doing that yet, but providing an updated report with a certificate of completion, a letter, notes that show what work has been done. Because if not, that 3-year-old report will be, as Kieran says, torpedoing every sale.
That's a very technical legal term. You shouldn't just throw that around loosely like that.
Yes, I'm not a lawyer. This is not legal advice. It will be torpedoing every sale in your community till the end of time.
Which hurts everybody. Well, let me ask Jeremy this question, because and again, it's going to vary from the inspection company to inspection company, but I've seen a trend where you have the company's going to give you a draft report, and they actually won't give you the final report until actually some of those repairs have been done. Have you seen that trend in your side, Jeremy?
Yeah, we've seen it a little bit, where they'll issue a draft report, give the association board a little bit of an opportunity to line up vendors, get some of the repairs going, and then they'll issue the report to show that work is in progress, some has been completed. They can write on there that this has been completed, critical repair is already done. Yeah, we've seen that a little bit, but it's at some point it feels a little overreaching. I mean, we're having lenders now reach out asking for copies of paid invoices for some of the repairs, which is really, I mean, that's pushing a bit when you should be referencing the report itself. So I agree with Natalie that at some point there's got to be, where do you close the circle or loop it back in into the report itself? Because that's the document you want to push people back to, not contractors' invoices, payments, that kind of stuff. You want it to be back on that report itself.
No, I'm thinking that what's going to have to happen is there's going to be some industry standard that is going to be created that should be honestly the responsibility of the contractor, to kind of say that we've completed this work with some sort of stamp or inspection. Maybe a board member can sign off that work was noted as completed per the scope of work in that report. Because, I've worked in construction before, and if you don't do it at that time, you can't go back 6 months, and an invoice is not proof of repair. I think that's wild that an invoice is proof of that they were billed.
Yeah.
It is not proof of repair. So that I think is overreaching. And I would have said, well, let's come up with a different way to maybe resolve this. But I do know why the lender was doing it. The lender wanted to sell that house, and it was probably fine. It was probably a great unit, and it was probably didn't need any repairs. And they're like, man, we just need to get this wonderful new homeowner. This woman, yes, this family wants to move. And all you're just, it's you, Jeremy, it's you. Give me the invoice. And that's what we're dealing with. And so I think, and this is such a new thing for all of us. They're new reports. They're new to our boards. They're new to our associations. They're new to our attorneys. They're new to our contractors. So we just need to develop a system in which it supports the lending institutions as best possible.
Well, if you want to go really, Wednesday night before a long weekend, glasses half full, optimistic approach here. If you think about after the issue in Florida, right, where you had the tower collapses, and so that a national organization, the Community Association Institute, did a study, and they came up with this list of best practices, and they made a bunch of recommendations about what associations should be doing. And we who live here in California, we're overregulated, if you will, in the HOA world, but all the ideas about reserve funds and inspections and those type of things that we have just been used to for decades, they don't exist in a lot of the other community or other states. And so that when we go back to the lenders and you're trying to, Fannie and Freddie and these gigantic bureaucracies and trying to help them understand things, we're definitely an outlier in that world. But in those reports that came out of the Champlain Tower collapse, we're all about best practices and recommendations. And you're starting to see other states starting to adopt some of these inspections and the reporting requirements. And so the more people that get involved in it, the hope is that it's going to educate the people in the process to recognize that what's the benefit of that report and what's the key information they can glean from it. And as we've talked about throughout the whole night, is it's not a matter of the fact that the people in the lending process can't read, they just don't understand what they're being provided. And they are all very interested in getting that loan funded because they all financially and benefit from that. But they're also risk adverse in the world that we live in. And so that's the hope, is that people are going to start understanding what the information is you give them. Because when you get right down to it, that report really, the information that comes into your reserve study that says, X amount of balconies replaced, Y that need to be repaired, and Z that don't need any work done at all, basically boils down to a number. And then there's like, is there money in the community to do that? Or is there a need to do any kind of special assessment? That's really the key question they should be asking. And that's not what they're asking at all. So that's the thing that's unfortunate about it.
Yep. And so let's actually move forward. And so once we have this condo questionnaire, if the loan is denied. So again, let's just review the common loan denial reasons are insurance. That's the number one. Critical repairs. That's generally generated by that condo questionnaire. Also deferred maintenance. And I kind of joked about it earlier, but there are some communities with a lot of deferred maintenance. I'm not talking about a little wood rot or some stucco patches that need to be done. I'm talking roofs that you can see through. Okay, so things like that is absolutely something that is going to get your community denied, and honestly probably should, because you need to be maintaining your units to be able to sell them and maintain value. Reserve funding. I haven't touched on this yet. Reserve funding is very important, and it's very subjective. So the actual written criteria for both Fannie Mae and FHA, which are the two bigger players in what we're discussing right now, is that 10% of the annual budget must be a line item on your budget and funding the reserves in a regular fashion. So in a periodic funding. So typically this is monthly. And so your budget not only has to have a separate line item for reserves, it must be a minimum of 10% of the regular assessments. So if you've got supplemental, like maybe you've got laundry income, or you have a cable situation where you are taking in money to pay out a cable bill or electricity or shared amenity in that fashion, that where it's kind of like a pass-through cost, that doesn't need to be included, just your regular assessments. And they are going to check and make sure that it's happening. So they request often last month's financials, balance sheet, income statement, and then the year end prior. So they can tell if the reserve account is being funded, and also how much do you have to have in your reserve account? Well, that's a really good question, because nobody can really tell you just looking at your documents. They don't know your amenities. They don't know the style of units. They don't know much. So they're going to lean on what your reserve study. And your reserve study might not be 100% accurate. You might have had it done 2 years ago. It's well within the guidelines of California state, which is 36 months. Is that right, Kieran? 3 years?
Every 3
Right?
years, yeah.
So every 3 years. So you might have had one done 2 years ago, and that's no longer accurate. So what they're going to ask for is a list of what has happened, the maintenance over the past 2 years since you've done that. Another reason to keep a maintenance log, because they're going to look at that and go, wow, they were, 19% funded in 2023. The reserve, it looks like their balance is a lot higher. Have they done anything? What does this mean? And then an underwriter is going to make a completely subjective decision based on just the paperwork in front of them. They have no nuance. They know nothing about your association. So sometimes we have to come back and ask you questions. Like, is there a plan to redo the roofs? It looks like their useful life was 4 years, 5 years ago. Is there a funding plan? Are there even special assessments? Is there a loan? And I know it's really frustrating, especially since the manager doesn't always have all the information or the time to answer those questions. And then Kieran, do they have to, like, if they've discussed a special assessment or a loan in a meeting, does that need to be disclosed to a future borrower?
Well, just to reiterate what I said a moment ago, the HOA's only obligation to provide any kind of disclosure information is to current owners. They have no obligation to any third party. So no one, the escrow, the real estate, those kind of folks, prospective purchasers, none of those people they owe a duty to. And the issue with regard to an assessment is your obligation to let the owners know about it is when the board has decided it's going to be imposed. And then you need to give them at least 30 days notice of when the HOA is going to start collecting those. Now, boards that have been looking at this, should be on their agenda, and they're talking about it and discussing it so the owners can come to the meetings and observe how the board is wrestling with a deferred maintenance issue or funding balcony repairs or however they're going to do it. But from a strictly legal standpoint, the obligation is triggered by when the board makes a decision there's going to be an assessment, and then it gives notice to the members when that assessment is due.
Okay, because that's always a tricky one. I have a lot of managers who say, like, we talked about it last month. What do I need to do? And
the best thing to do, really, honestly, and Jeremy, I think you can back me up on this too, is like, you from the board trying to prevent itself from being criticized by the members when you have that town hall meeting because you're going to do an emergency assessment or you're going to get a loan or something. It's always great to say, well, if you look in the agenda for the last 6 months, we've talked about this issue. And so the fact that the members had the opportunity to participate in it, they may not have been there, but it's because the owners are frustrated because they're just learning about something, and you want to be in a good position as a board member or as the management team to say, hey, we've been very transparent about this. We've addressed, we got the SB 326 report back. We had the consultant come in and talk to us about what does this really mean and help us go out and get a bid from general contractors who are actually going to do the work. So now we know what the actual cost is to complete the items we have to do in that report. And then we've talked about how we're going to fund it. Like, what do we have in the reserve fund? And so being able to point back in the agenda is your get out of jail free card, because you've disclosed this. And if the members didn't attend those meetings or ask for minutes and participate, well, that's unfortunate, but at least you're protecting yourself as either the management team or the board from liability, which is sometimes all you can do.
Yeah, I fully agree. The more opportunity and the ability for the board to let the membership watch them deliberate, discuss, have conversations with the community, the better the entire community is going to be. I mean, that's the right of a homeowner, is to watch the association's board make decisions, deliberate, work through hard issues, ask for feedback from the membership, and then when it comes down to it, make the decisions that need to be made. But I fully agree that being open as transparent as you can, I mean, there are limits to that. Certain things need to be behind closed doors. But when possible, I think boards should err to the side of letting the membership watch them work through some of these challenging issues, because they have that right. They own the property just like the board members do. They should be involved as well and add their comments and commentary and expertise as well. So I agree with you. It should be as open and transparent as possible. It should be posted in agendas, and even in the minutes. Did the board make a decision? What's the next step? I think absolutely, fully agree with you on that.
And I also want to point out one thing. So I don't have special assessment as a common loan denial reason, because it's actually not. Fannie Mae, FHA, they love a board with a plan. That means that you've identified the issue and you've come up with a way to fund it. That is way more positive than just sweeping something under the rug. And I mean, they don't want to see that it's, $100,000 per homeowner and you've got 30 days to pay it. But a plan is better than no plan. But I did miss something on the common loan denial reason, and that is litigation. So litigation isn't an immediate red flag. It's the type of litigation. If you are a newer condo and you are under construction defect, that is the no-fly zone for lenders. They want to see that defects lawsuit has to be settled and repairs have to be completed. So that can take a long time. And so it's one of those things, and I've had CDL attorneys on one side, and I've had board members on the other side and go, what do? We're going to, again, torpedo sales if we do this. But then you've got people saying, well, if we don't do this, we are going to be in a pickle. And so it's really one of those things for newer communities to discuss. But that one is a huge red flag.
Well, Natalie, one thing I would say, and I'm sure Jeremy and Kristen have experienced this too, is that especially when you take over a property that has been managed by someone else, or that someone else is their counsel and they've gone through that process, and there's some law firms that just kind of specialize in that litigation, and then they pass it on to a firm that does more of a full scope of work, and so we'll do the reconstruction project side of it. And so there's actually a civil code section 6100, which does exactly what you were just talking about, which is the idea of you write a letter to the members and you basically list, here's everything that came out of that lawsuit. And you break down like what you got in the recovery and what your plan is to move forward with that. And it's interesting that I've taken over properties where, 4 or 5 years after the construction defect lawsuit, and they've still not sent that letter out. And it's not a great idea, because you're right. You're leaving people in limbo. Like, hey, well, the HOA just got $5 million. Like, we should be all set, right? Well, who knows? If the cost of repair is 10, maybe it didn't. And so giving that information to the members and, following that civil code 6100 requirement, that's a good thing that a lot of associations don't seem to do as frequently as they probably should. And it comes back to bite them, I think.
Also, I've seen lenders, FHA specifically, see that, that $5 million sitting in a bank account and then want that covered by Fidelity. And that, Charlotte, a $5 million increase isn't as low cost and easy to get.
It's not as low cost, and not every carrier can go that high.
Correct. And so it's not a $10,000 increase. So there's lots of things to discuss. And litigation that is a red flag is if it has the word mold. That is really, and you can write a letter and say it was mold in one unit, not the unit that this is infected, and that generally gets it by. But you're going to need that letter from your attorney. You can't just pinky swear or send an email. So there are some things that might need to be generated by an attorney during just kind of routine litigation that might be flagged. But if it never is litigation regarding collections, that does not need to be disclosed at all. That is standard lien on somebody who hasn't paid their assessments. That does not need to be disclosed.
I thought one of the signs of the apocalypse, because something popped up and said, I'm the host.
Yeah, this is scary. Kieran's never the host.
Where's Kristen?
Look at it. His voice just cracked. Okay, so the remedial actions that need to be taken, if you find out that it's insurance or budget, those are kind of things that you walk through with your professionals, your manager, letters of clarification regarding legal issues, proof of work that's completed. I would suggest something other than invoices. And then send it to the lender, the person who told you about it first. Keep them in the loop, because they're going to be your easiest access to fixing the problem. If they go away, you now have lost a big piece of that loop, and you're going to have to start all over again as the manager and go visit that horrible Fannie Mae site. I hope this is a private recording, because I love Fannie Mae and I want to work with them a lot in the future.
It's password protected. You have to be a client of Jeremy's or Kristen's
Okay, good.
to get into that.
Excellent. Or just, they could just update their website and make it user friendly. And so
Now who's being glasses half full, Natalie?
Yeah. Okay, so moving forward, this is Kieran's favorite slide. If I don't get my loan, I'm Natalie, I really want that condo.
Yeah.
I don't get the loan, I'm going to sue the manager and the board.
So when we were originally putting these slides together, that my thought was this slide should actually say, it's not your fault, managers and board members. But then Natalie persuaded me to have a little more provocative title. And so if the slide comes back up and says legal, perspective, is the board or management liable for loan denials? And so the answer is hell no, you're not responsible for it. But there's ways in which you can protect yourself, because that when that happens, God forbid the loan doesn't get funded, that the owners sometimes are looking for someone to blame. And who is the number one person anyone blames in a community association when anything goes wrong? The management team. Who's a close second? The board members. And so that's something that you can definitely do to protect yourself. There are some things you can do. So one is from the board side. And we talked about a moment ago. It's like that you have a zero legal obligation to provide updates to anybody other than the owners. So whatever it is you're providing, and as we talked about, your savvy management teams using the portals like CondoCert, like Keystone and Manor are doing, it makes it very simple because they're doing a lot of the hard work for you. The documents that generally are going to be requested are in there. And so that now that you are not providing it to a third party, and if something goes wrong in the process, they can't come back and point their finger at the management company or the board and say, well, why did you provide some document you shouldn't have provided that affected my interest rate or affected my loan? So be careful about that. Provide it to the owners rather than providing it to the third parties, no matter how much they ask you for that. Okay, there's the slides back. The second thing is from a contractual standpoint, and this applies mostly to the management team, but also the board's got a role in this. And so most of the management contracts talk about the managers are managing agents of the corporation, and they have certain duties that they're assigned to do under that contract, but generally they don't do things unless they're directed to do them by the board. And so that's a good thing to have a good line of communication in where you talk about how this process works and what people's role is in this. And that they talk about the road to somewhere being paved by good intentions, right? And this is where that often comes up, is that you as a board member are particularly vulnerable in your community where you're walking the dog, getting the mail, or your neighbor or your best friend for 20 years is trying to sell their home, and you really want to help them out, and you start jumping in the process, and you're causing a lot of challenges. And so having a good discussion between the board and the management team regarding what everybody's role in the sale process is really, really important, because you may really be trying hard to do something to help your neighbor out. Inadvertently, you may say something that conflicts with something the management team said, and next thing you know, there's a red flag there. So having a clear delineation of what everyone's role in the process is really important. The second thing to think about is indemnification. So the contract between the HOA and the management team is a unique relationship, and that if you've ever tried to get indemnity for a third party, like a contractor, that it's almost impossible to get. But the one exception to that that's almost universally granted is the fact that because the managing agent relationship is such a close relationship to the board, that the association's insurance invariably provides indemnification for the association. And so indemnification for the management team. And so you want to make sure that you have that established, so the contract requires it, and you're giving the information needed in order to preserve that indemnification requirement, because you need it in order to allow the manager to be able to do their job and have the freedom to do what they need to do to help you run your community on a day-to-day basis. So you need to give them that protection, and also the clear direction, like we talked about a moment ago, about what it is they should be doing, so everyone understands their role in that process. Transparency, as we've talked about throughout the evening, is really, really important, but you want to do so in a way that you're not putting yourself in jeopardy. And so I know this sounds like a legal kind of thing to say, but and it is, because you're trying to protect yourself either as a manager or as a board member from liability. And so giving statements, we're providing some information saying, to the best of our knowledge, or at this moment, you're giving yourself a little bit of room that, as Natalie mentioned a moment ago, you may be providing an SB 326 report that was done in June of 2024. And that someone at the other end is receiving this and they're going to say, oh, that's the ground truth of what's happened. Well, no, it's 18 months old, or I guess 13 months old. And so you're in a position where you want to be able to say, hey, as the time this document was written, this is what it is. So give yourself some, you can still be transparent, but in a way that helps protect yourself from liability. Another thing you want to be careful about is covering your backside, right? CYA, cover your assets, right? And so one way to do this is document, like, what have you done? So if you've produced that report, you've gone out and started to make those repairs, as Jeremy mentioned, people are starting to ask for that stuff. So show that, hey, we've got a bunch of balconies that are in the red category that we need to address right away, and start showing that you've got a plan and then you're following that plan, and document steps along the way. So if you are asked by someone in this process to provide that information, you have it readily available. So the 2 bullets about maintaining good documentations and records are important. And so that it's funny, we were talking to Kristen as we were putting this together, and we were talking about back in the pre-digital days, when everything was, you CC'd copies of stuff, and you had a unit file for one thing, and you had the escrow file for the other. But as we've gone into the digital world, it seems like sometimes that doesn't always happen. And so the fact that you have the documentation is only valuable if you can actually put your hands on it when you need it. And so err on the side of caution, right? That we're all in the cloud these days, data storage is pretty cheap. So, put it in the, unit 7 file when you're providing in this documentation, and then also have it on the escrow side. So if the person who runs your escrow department's on vacation or maternity leave or whatever, and someone else is filling their seat, they can find that information, because otherwise it could be a black mark against you, even though you have done the record keeping, but you're not found it in a way that's very accessible. And then finally, we just talked about earlier, the consistent communication, that, what's the role, the primary relationship in this escrow process should be through the management team, because they're professionals. They're the ones who know what's going on. And be careful about members of the community that, board members, I get it. You really want to help people out. You join the board because you want to help your community, but be careful. You can inadvertently, through good intentions, put yourself in a challenging position. So try to resist the temptation when you're walking your dog, going to the pool, and you run into somebody and they start asking you some questions. You discipline yourself to say, well, you got to reach out to the management team, and they'll work through this process for you. They've got a procedure for it. They've got a whole escrow department. Give them the company line and try to stay out of it to the extent you can, because you may have good intentions, but you might accidentally make the process more challenging.
Yep.
And if you do that, you can make yourself liable, and you certainly don't want that. You're all volunteers. You don't want to put yourself in that position.
We actually already did this kind of slide.
Yep.
Jeremy, you've got to skip one more ahead. There we go. So let's review just some quick tips and takeaways before we do some Q&A. Respond quickly. If you're a manager, you've got just a few days sometimes to get this information to a lender when they're in the middle of a sale. So if you can respond quickly and make it a priority, that's excellent. And that's coming directly from somebody who asks these questions a lot. So just get right back to me. Put it at the very top. I always suggest also creating a general community info packet with very frequently requested items, so that you can, are there leasing restrictions? Sure, here they are, they're right here. Owner occupancy numbers and special rules and regs that are commonly misunderstood that might affect somebody's reason to purchase a home. Parking, something, what is it? Parking, pools, and pets. Those are the 3 Ps that people have issues with. And just making sure, like, you move in and you can't have 3 dogs. Those are the kind of information that it really affects a purchase and somebody's happiness, and on the other end of it. Create and maintain a repair and maintenance log with completion dates. We've already discussed that. Keep an electronic folder, especially if you're using an online portal, which I'm sure, I mean, Keystone, I think Kieran mentioned, possibly they're using condo certs. That's great, as long as that information is updated regularly. I often run into this in January of any year, the old budget's still there. And so you're always, you need to get that, but I just waited 10 days to get that information. So and I paid for it. So if you could please just send me a copy of the new budget, things like that. And that's those are things that'll hold up a loan for really no good reason. And the next slide, Jeremy. And education. Everybody here is already light years ahead of any other, community and board member and manager, because they're taking the time to learn and to even just open up this discussion. At some point, you're going to go to a board meeting and you're going to say, wait, I listened to this whole thing about lending. Is changing our insurance is that going to affect people's ability to get loans? And your manager is going to say, you know what, I'm going to call our insurance agent, or I'm going to call Natalie, and we're going to figure this out. But that's just having the conversation is the first step. Also knowing, one of the horrible things and the tricky things about this industry is this is not all left up to us. Any day now, Fannie Mae can make changes, FHA, all of these agencies make changes regularly. They announce them like this in a whisper and in language that an average human with a law degree might not understand. It is very tricky to decipher half of the stuff that they write down, so using industry professionals and using your resources to make sure that you're getting the right information all the time on an annual basis is an excellent tip. And then board members, before you make those CC&R amendments, see how they can affect financing, because it sounds great that you don't want any renters in your community or you want a rental cap. If you do that, VA doesn't want to touch you. You can no longer have veterans, which is one of the highest performing loans, great neighbors, great people, served our country. They cannot live in your condo association if you restrict renters. It's one of those crazy rules that doesn't make any sense to anybody, but that's just one of their criteria. And then treat everyone fairly. I don't know how many times I've tried my best to get somebody a loan, and then another person comes along with a different story who might approach it a little differently, and all of a sudden people are responsive. So just make sure that everybody in your community has the same rights to the same information that you do. And you can also find yourself in a real bad situation if you're providing information to somebody and not to another person. And then homeowners, my biggest tip, this information is your information. Request it ahead of time. If you're going to sell your unit or refinance, get those condo. You can go to your sometimes you have a portal. Sometimes you have this information in your budget disclosure and you don't even know it's there, and just have it prepared and send it over to your lender before you start anything. And they can do a pre-evaluation or a review and see where you stand. And then also choose a realtor that's experienced in selling in HOAs, mostly condominiums. It is so much easier for everybody involved. You will get a higher value, a higher return if you use an expert. And so everybody will be very pleased during your transaction. So does anybody have any questions? I remember we had a gentleman named John.
There's a bunch of questions in the Q&A.
Oh, I don't know how to work that. So
yeah, I'll go ahead and address these. So I'll go ahead and read the
Jeremy.
question out, and I will turn it over to the panel. First question was, how does the ratio of owner occupancy affect insurance dues for a building and mortgage options? Our association is contemplating raising the rental cap from 25% in the CC&Rs to 30% or even more.
Well, I can address the insurance question, and I will say that every insurance company is different and has different requirements. I have some insurance carriers that are fine with any rentals that are, under 50% of the community is occupied by renters. And I've got other insurance carriers that have a very strict 25% cap. So it really does depend. And if your particular association is looking to amend the governing documents, sounds like it's a relatively small amount that you're proposing you amend it to, you would probably want to have a conversation with your insurance provider and just ask, is this going to be a deal breaker for our particular insurance carrier?
Yeah, and for financing, 30% is totally fine for all agencies. If you are going to amend it though with that rental cap, send me an email and I will send you some language on being able to maintain VA certification while having a rental cap before you do the amendment.
Great, thank you. Next question is ineligible list the same as blacklist list? Is the blacklist per complex or per unit?
That is the same. The blacklist is what we just call it on the streets, and Fannie Mae calls it their ineligibility list, and it is per association.
Thank you. Next question is, are you saying that if you have a 25,000 deductible per instance with 184 units, I need 4.6 million in the bank?
No, not per instance, Charlotte. I think it's a per unit, totally different deductible, right, Charlotte?
Yeah, sorry. So if it's a $25,000 per unit deductible, the lenders are taking that per unit deductible, multiplying it by the number of units. And if that number, that total, that sum exceeds 5% of the total insurable value, the lenders are having issue with it. Does that?
Well, what's a 25% per instance? I think that means like if there's a fire and you have a 25,000.
Yeah, 25,000, not percent. Right? Did you
Correct.
Yeah.
Well, I think the thing too, Natalie, you would know more current information, but that Fannie and Freddie and FHA also have maximum deductible numbers too. So that's something to be careful about too, because that could put you in a challenging position to try and get a loan if your deductible is 25K. So that may be something to consider.
Not necessarily 25K. It's well, Fannie Mae is 5% of the total insurable value, but I think this person was confused between a standard deductible, which is like 25,000, I think, per occurrence,
right,
and $25,000 per unit.
Yeah,
so
I got you.
correct.
Like a catastrophic loss, and you have 100 units, you'd be paying $25,000 per unit to rebuild, and that number is a lot of zeros and probably too much.
Yes. Versus the more standard policy is going to give you that set deductible per occurrence.
Yeah.
This is probably a good time to chime in and I'll do my best, Charlotte. It's like, so Charlotte doesn't write personal lines coverage, but you should talk to your personal lines insurance provider about the HO6 policy you have as a homeowner, all your homeowners and condos out there, and then talk about loss assessment insurance coverage, which is reasonably affordable and can be a blessing if you find yourself in a situation where your community is imposing an assessment. So talk to your provider about HO6 coverage and about loss assessment coverage you can get, not just at the baseline, but you can also increase it for a modest increase in premium. So ask.
Yeah, and I did, Kieran, I promised you I would do a little bit of research because I know kind of the standard carriers will say on the personal line side, we'll give you up to $10,000 in loss assessment. You can actually purchase higher limits. Not every insurance carrier is going to do it, but you can find it. And I did find out that some carriers will go as high as 100,000. Typically, you're going to see increments of more like 10, 15, and 25,000. But if you need to go higher, you can find it. It's just going to take a little bit of research.
And it's surprisingly not that expensive.
Right. That's my understanding.
Yeah.
All right, guys, thank you so much. The next one looks like it's a comment. The proposal of turning the insurance from the HOA to the individual condo owner was presented as a discussion with our board, and we turned it down. It was not approved, and we kept it as a part of the HOA responsibility due to the discussion of what individual homeowners would say, ... not a good idea.
We agree,
More
Frederick.
of a comment.
We're finding the same thing.
All right, next question is, can we get those names of the electric panels that are bad or should be changed out, please?
Let's see if Natalie was paying attention and she's going to hedge and say like, as this time, these are the panels that are on the list. To the best of my knowledge. Let's see where she goes with this.
Well, this is a Charlotte question, but I know Zinsco is the
That's the big one.
Yeah.
Yeah.
FPA federal, yeah.
Challenger.
Right now, the big names are Zinsco, Challenger, Federal, Pacific, Stablock.
Yeah, if you're Stablock, not good. Yeah.
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 I say right now because they've added some names You know, honestly, Challenger wasn't on there, and then it was. So those are the big names now.
I would throw out something to you folks, because I'm going through this with one of my communities right now, where they hired an electrician because they had an owner who came to them. They were in the process of doing a solar install. The electrician was working with a gas electric company, and they had to, pull a permit. And they said, "Oh, we got this old panel and needs to be replaced." And so the community, being forward leaning, said, "Oh, well, we should find out how many of our community members might be in the same situation." So they hired a licensed electrician to go out and look. But they didn't do the homework, at least the individual writing the report didn't. And so they inadvertently classified a number of the panels as having been recalled, which of course sent like a red flag, across the sky. And the carriers are like, "Well, we're not going to drop you now, but you got to replace all these panels, in 6 months. Otherwise, we won't renew you." And it was all based on faulty information because the electrician didn't do their homework, and they were lazy, and they basically said, "Oh, these have been recalled." It turned out they hadn't been, but unringing that bell has been very challenging. So if you find yourself in that category where you do have panels that need to be replaced, work with your management team and make sure you get a very capable electrician to work with you and provide that report. Otherwise, you might find yourself in a very challenging situation.
Yeah. All right. Thank you so much, Kieran. Next question. This is going to be on a hot topic over the last couple of days. The new AB 130 law Newsom signed, only imposing $100 fines does not always motivate people to make repairs. This may injure the ability to get our HOA insurance.
I can't think of a positive single thing to say about AB 130. It's one of those nefarious backroom, smoke-filled deals that were made, late Wednesday evening last week, and it was added as a rider to the budget bill, so it was impossible for anyone to challenge it. It never went through committee, never went through any kind of public comment period. And so, 5 days later, Governor Newsom signed it, and it's a law. So it's a troubled history of how we got to this point. And I agree with you that weirdly, they seem to think it's a situation where having those fines capped at $100 is going to be a positive. In reality, I suspect it's going to cause a lot more alternative dispute resolution, a lot more lawsuits, because you're absolutely right that, if people aren't doing what they need to do, that the association, will have less tools in their toolbox to try to get people to resolve it. And one of those first steps was almost always call them to a hearing, impose a fine. And now you don't have that. So I agree with you. Terrible, terrible bill.
So on the insurance side of it, just because there was a mention of insurance, and this could, if fines aren't motivating people to do what they should to gain appropriate and affordable insurance, this could be an issue for the association. The one caveat I'll add to that is I have seen some governing documents, and Kieran, you can probably speak to this as well. I have seen some governing documents have a stipulation in there that says if any one owner is doing or not doing something that is increasing our cost of insurance significantly, that unit owner, that person is responsible for the difference. This can be a very serious motivating factor for them to do whatever it is. So for instance, if you know that a unit owner has an electrical panel inside their unit that is an issue, and everyone else has replaced their electrical panels, and you're finding yourselves insured by the surplus lines market versus standard simply because of this one electrical panel, but they refuse to replace it, refuse to let you in to inspect the electrical panel, well, guess what? You can give them the $75,000 bill or whatever it is, the difference between an admitted insurance policy cost versus the surplus lines cost.
We had that exact situation arise in one of the communities that our firm represents, and you're exactly right. It's like, you don't have to replace your panel because it's $6,000, but you do have to pay the difference between our admitted carrier coverage and our non-admitted carrier coverage. So it's a good
the
tool.
asterisk, of course, is you want that in your governing document. So if it doesn't exist,
most of them do have some version of that.
All right, next question. It's impossible for condominium communities to obtain full replacement coverage for wildfire. How are lenders viewing this? At best, we can get up to $10 million in coverage at a premium of about $26 million. 26K million in coverage.
I know this has been really, really difficult. Not everyone can find the coverage. Ways we talk about getting creative, ways that we've been able to navigate this for some of our harder to place clients that are in high fire risk areas. That's not everyone, but of course we have some. They've been able to get a policy that excludes wildfire. So they get a fire policy through typically a surplus lines insurance carrier, and then they purchase a separate policy for wildfire, whether it be through what we call a parametric program or a separate wildfire policy. I'm going to be honest with you, I'm one of the voices that's really pushing our legislature to put a solid definition of wildfire. I know that sounds crazy. We all know what a wildfire is, but we want to see those definitions in what we call our ISO forms for California admitted insurance companies, so that the California admitted insurance companies can also offer this and give you a separate policy for fire versus wildfire, similar to what earthquake does now. So it used to be that you could get earthquake in your package policy, and then long ago, decades ago, they separated it out, excluded difference in condition or earth movement from the standard policy, and you can buy a separate earthquake policy. We're pushing to have the ability to do that on the wildfire side for those harder to place.
And Charlotte's point is really valid. And just to kind of look at it another way, like you are far more likely to have a grease fire in your kitchen than you are to have a wildfire, but that affects your entire community. But unfortunately, the insurance industry looks at them, fire is fire, and they don't make that distinctions. But one of the things you're starting to see too in the surplus line side, that like we talked about the flexibility and their ability to be creative. So back in the not that distant future, and if you have old CCNRs, you might even see it, like the named perils policy. And so you could have, instead of it being an all perils policy, which is much more common in this day and age, you could name all the perils and just exempt, certain things. And so that's an option too that might start coming back around, because the idea is you want to make sure you're having, like we said, the full pie of all the coverage you need, but do it in the most cost-effective way possible. And so if you have a higher deductible for the wildfire, where it's less likely it's going to happen, but you have a much more modest, reasonable coverage for for a grease fire, you're in a much better place.
Mm-hmm. And this is the big push, and this is why we voice, ourselves at the government level, is we really just want California admitted insurance companies to have the flexibility to make these adjustments, because ultimately it comes down to more affordable insurance for you, the consumer.
Right.
And
rumor has it the commissioner of insurance may be thinking of running for governor, and so that's an elected position. So maybe he's going to try to do something to help his chances. So
regarding how it affects lending, it's a mixed bag. So there's nothing that says you must have 100% wildfire insurance. You must have 100% replacement cost, which is a technicality. I'm not sure. I've seen it go both ways. And again, it depends. It's one of those nuances where if you've got an excellent borrower who's putting 50% down and is not very risky, a lender might go for it. If you've got a 3.5% down and with a lower credit score, they're going to really dig deep and possibly reject that. Will it end up on the lender ineligibility blacklist? Maybe. It all depends. It's one of those things I'm scared to ask about, because I don't want to be the one to bring it up and say, like, by the way, if it says wildfire excluded, because then I don't want everybody at Fannie Mae or FHA to be like, wait, they're excluding wildfire, and then start that. So I'm kind of waiting to see. FHA has been okay with it. Mm-hmm. They've totally been okay with it. And I have policies, I push policies through that say wildfire excluded. Mm-hmm. And I've talked to the lead condo reviewer in Santa Ana, and he said, yep, because they go off the guidelines. The guidelines don't say wildfire is mandatory. Same as earthquake. Earthquake is not mandatory. So they look at it in the same realm. That the sun is shining, sun setting.
Sun always shines on you, Natalie.
Yeah,
we are right at 7:30. We've got a couple questions here. Let's see if we can jump on them, and then we'll close out the evening. What is considered a good reserve percent? What is the cutoff for poor?
An excellent question.
Okay, I'm just gonna go there. Man, if it's 65% and up, I'm like, this is a winner chicken dinner. If you get under 20%, I really start looking at what's going on. Most of them are between 20 and 60. Honestly, I mean, like like a normal condo association that has roofs and pools and things like that. FHA and Fannie Mae also will dig a little deeper. Is this a one building condo project with one roof? Is this 40 different duplex style units with balconies and staircases? Are there pine trees nestled up underneath each one of the units and growing through the roof? Were there creeks installed? So it's things like that. And they're mitigating their risk. So in my office, under 20, we really look at. 20 to 60, we always are good. 60, we don't look at anything else.
Great, thank you. Are we required to provide the whole 534 pages of our balcony inspection report to each lender versus providing a report for the specific unit that's in escrow?
So Melissa, just to recap what we talked about earlier, there is no legal requirement in California that you have to provide that SB 326 report to even an owner, much less lenders or escrow agents. However, that you don't want that to be the impediment to, that's the reason that the loan is not getting funded. And so that's something that the board should look at. We talked about trying to do a stair-step process, which is say, like, let's start off by offering to provide just the page or two that addresses the specific home that's going through the process. That works quite often, but I think that it's ultimately a board's question, to discuss with the management team. But ultimately, I think a lot of boards have fallen in the decision of, hey, I'd rather provide the report to the owner rather than have that sale not go through. But we talked about making sure that you're sending it to the owner. You're not sending it out to the third party, the prospective owner, the lender, the real estate agent, someone, because then you can find yourself with some liability. Give it to the owner, let the owner do what they want to do with it, and that way they can't point the finger back at you.
All right, Amber had a great question here is, can we claim insurance for SB 326 repairs?
Charlotte, you want to start with that?
It will very likely be declined. Remember, an insurance policy is not a maintenance policy. And if there's some repairs that need to be made based off your SB 326 report, typically this is going to be some deferred maintenance that needs to be taken care of. I am not going to say you may not turn in a loss, but I will say I'm 99.999% positive it will be declined.
So one other thing, just to revisit what we talked about a moment ago, and maybe this didn't make sense at the time, but in this context, maybe it will. We just talked about the HO6 policies. So the homeowner, individual homeowner policy. And we talked about that loss assessment insurance option in there. And so if you're in one of those communities where there's no insurance coverage for the repairs, and the HOA has to go out and do a special assessment or an emergency assessment to fund it, that's where your insurance may help cover this. And that's why we were suggesting a moment ago, talk to your personal lines broker, who's writing your auto and your home and so forth. Talk to them about this. Talk to them about the ability to have the loss assessment coverage, and then see what the cost would be to bump it up to a reasonably high number that, if you could find yourself with coverage as an individual, not as an association in this instance.
Yeah, and my understanding is there's two different types of policies or endorsements to that. So there's special assessment and there's loss assessment. Loss assessment, there would need to be a loss that triggered the deductible, and then you can get some coverage for the deductible. For special assessment would be something like this. There's an unforeseen cost, and everyone's special assessed for it. So just be careful, make sure that you're talking to your surplus lines provider and asking for these two kind of hypotheticals. Where can I find the coverage?
Right.
All right, guys, thank you so much. This is our last question of the evening. If a community is on Fannie Mae's blacklist due to a misunderstanding, however, there isn't any lawsuit involved with it, what is needed to move the community off of the blacklist? Is it enough to repair roof issues, which the developer finally reimbursed after mediation. We were told by our lawyer that roofing issues are the only critical issues. All other items are aesthetic.
Yeah, so the first thing I would do is try to get the exact language or the exact reason that you are denied. If you have access to a lender, a Fannie Mae lender, have them look it up. If you need more help, you can send me an email. I have a contact that can, I don't want to give them out, but that can take a look and I can possibly get you more information and then go from there. So if the denial, because a lot of times people don't have the proper information, if the denial is this roofing issue, then we'll take it from there, how to prove that it's no longer an issue, send it over to Fannie Mae and have that updated and go from there. But first thing is to find truly what it is that the issue is.
And have a plan and show your documentation that you're executing that plan and,
Yes.
and getting milestones. All those are good things to do, and document it and stick it where you can find it. When we talk about the beer truck thing, right? Like if Natalie gets hit by a beer truck, who can find that report? So you want to make sure you put it like in the unit file. You want to put it in escrow files and places where you're getting credit for you've done the homework. You want to get credit for it.
Yep.
Excellent. Thank you guys so very much, homeowners and board members on the meeting this evening. Thank you so much once again on behalf of Keystone and Manor for joining us this evening. It was an amazing conversation and great information by these three amazing pillars of our industry. Join me in thanking Natalie and Charlotte and Kieran for their time this evening. They were amazing. So make sure you reach out to them. Should you have any questions, reach out to your manager. And once again, thank you guys for being here this evening on behalf of Keystone and Manor. Have a great evening, and thanks again.